Welcome back, my friends. As you all know, many YouTubers are talking about real estate. Some are predicting a collapse. Others are cheerleading for a new surge in real estate prices. But most of these people are talking about residential real estate. Almost nobody is discussing commercial real estate. This despite the fact that we are hearing headlines about vacant office space. Well, today, we hear about defaults on 2 office towers in downtown Los Angeles. So, what does this mean for commercial real estate? What does this mean for the real estate industry? What does this mean for the future of the economy? And, what does it mean for the future of the United States? But, before we get into that, please press the like button and leave us a comment below. Please hit the subscribe button and hit the bell icon so that you are notified of upcoming videos. It's a major sign of struggle when huge office landlords are defaulting on their loans. Brookfield is the largest office landlord in downtown Los Angeles. And now Brookfield is suffering blows from dissolving demand and rising interest rates. The corporation defaulted on loans tied to 2 office skyscrapers in the city: the Gas Company Tower and the 777 Tower. These 2 iconic buildings carry loans totaling $784 million. First of all, what are these properties? The Gas Company Tower is a skyscraper located in downtown Los Angeles. It is a 52-story building that stands at a height of 757 feet. It is one of the tallest buildings in Los Angeles. The Gas Company Tower was designed by the architecture firm Skidmore, Owings and Merrill. It was completed in 1991. It was built for the Southern California Gas Company. It actually served as the company's headquarters until 2015. Today, the Gas Company Tower is home to a variety of office tenants. It is considered a prominent landmark in downtown Los Angeles. The building is located at the intersection of 5th and Olive Streets. It is within walking distance of many of the city's major attractions and cultural institutions. The 777 Tower is a high-rise office building located in downtown Los Angeles. It is a 52-story skyscraper that stands at a height of 725 feet. It is also one of the tallest buildings in Los Angeles. The 777 Tower was completed in 1991. It was designed by the architecture firm Cesar Pelli and Associates. It features a distinctive triangular shape. It has a blue-green glass exterior that reflects the changing light of the Los Angeles sky. The building offers approximately 1.4 million square feet of office space. And it is home to a variety of tenants. The 777 Tower is located at the intersection of 7th and Figueroa Streets. That is considered a prime location in downtown Los Angeles. The building is within walking distance of many of the city's major attractions. That includes many well-known places: the Staples Center, the Los Angeles Convention Center, and the Walt Disney Concert Hall. Lenders have not yet foreclosed on the 2 properties. The properties are included in a portfolio named Brookfield DTLA Fund Office Trust Investor. But Brookfield declined to extend the maturity on the financing tied to the 52-story Gas Company Tower at 555 West 5th Street. And also declined interest rate protection for the 777 Tower property at 777 South Figueroa Street. We believe DTLA's decision to default on these 2 assets increases the risk for the remaining loans in their portfolio, Barclays research analysts Lee Overby and Anuj Jain wrote in a note Tuesday, according to Bloomberg. You may have heard the headline, Brookfield Fund Defaults on Los Angeles Office Towers. It's a major sign of struggle when Brookfield, the largest office landlord in downtown Los Angeles, is suffering blows from dissolving demand and rising interest rates, said Bloomberg. The corporation defaulted on loans tied to 2 office skyscrapers in the city: the Gas Company Tower and the 777 Tower. The properties carry loans totaling $784 million. Lenders also declined interest rate protection for the 777 Tower property at 777 South Figueroa Street. Brookfield's portfolio has a total of $2.28 billion in secured debt. This debt instrument also covers the 2 Wells Fargo centers. $500 million is due in October, and $263 million maturing in November. Office vacancies have increased across the United States. The downtown LA market has been struggling even since before the pandemic. The vacancy in the Central Business District is up to 24.5%. And, you already know about major lenders backing away from residential mortgages. Wells Fargo is stepping back from the multi-trillion-dollar market for U.S. mortgages. This comes amid regulatory pressure. And as the Federal Reserve continues to raise interest rates, Wells Fargo will now only offer home loans to existing bank and wealth management customers. The banking giant thinks that the lending market has collapsed. As you probably know by now, the Federal Reserve began aggressively raising rates last year. Wells Fargo is also concerned about and heightened regulatory oversight, both industry-wide and specific to Wells Fargo. If you recall, Wells Fargo was the subject of a 2016 fake accounts scandal. We are acutely aware of Wells Fargo's history since 2016, Wells Fargo spokesperson said. Under previous CEOs, Wells Fargo took pride in its vast share in home loans. Wells Fargo was the country's top mortgage lender as recently as 2019. Now Wells Fargo pursuing more revenue from investment banking and credit cards. Wells Fargo will more closely resemble megabank rivals, Bank of America and J.P. Morgan Chase. Both of these big banks backed away from mortgage market share after the 2008 financial crisis. The big U.S. banks stepped back from home loans after the housing bubble of the Great Recession. Non-bank players including Rocket Mortgage quickly filled the void. But these newer players aren't as closely regulated as the giant U.S. banks are. Wells Fargo is the third largest mortgage lender behind Rocket and United Wholesale Mortgage. Wells Fargo is also shutting down its correspondent business as part of its retrenchment. In fact, Wells Fargo is significantly shrinking its mortgage servicing portfolio through asset sales. The correspondence channel is a major business segment for Wells Fargo. 42% of the $21.5 billion in loans Wells Fargo originated in the third quarter were correspondence loans. Wells Fargo is currently the largest mortgage servicer in the United States. Mortgage servicing involves collecting payments from borrowers. That business has $1 trillion in loans, or 7.3% of the overall market. Altogether, the shift will result in a fresh round of layoffs for the bank's mortgage operations. But Wells Fargo executives declined to quantify exactly how many positions would be cut. Wells Fargo cut thousands of mortgage workers last year as business declined. The news does not really come as a complete surprise to investors or employees. Wells Fargo employees have speculated for months about changes coming under CEO Scharf. It's very different today running a mortgage business inside a bank than it was 15 years ago, Scharf told analysts in June. But he said that the bank will need to adapt to changing conditions. Real estate values have fallen across the nation, and macroeconomic factors are weakening overall. So, many investors have current needs for cash and need to liquefy some of their assets. Blackstone and Starwood Capital Group are drawing attention from the Securities and Exchange Commission. The real estate funds have recently seen a surge in withdrawal requests. It comes amid a broad drop in investor sentiment and potential economic downturn. This led both private equity giants to pause redemptions after monthly and quarterly withdrawal limits were reached. Investors in and outside of the funds took notice, as has, apparently, the SEC. The regulatory agency reached out to both Blackstone and Starwood. The agency was looking into how the firms served redemptions to their clients, and if any affiliates of the two companies sold their shares before the clients, according to one of the sources. The inquiries are not indications that either firm is under investigation or committed any wrongdoing, the report said. Representatives for Blackstone and the SEC declined to comment to Insider. Assets flowed into the fund and it was a success, at least for a few years. The Blackstone right amassed $68 billion in assets. But what a difference a year makes. The real estate market in the United States has reversed course. And investor sentiment is turning bearish, to say the least. Blackstone has taken heat over the past week for limiting withdrawals from the $69 billion private right. As you might imagine in a degrading real estate market, publicly traded rights have gotten slammed this year. If you follow this channel, you already know that the Federal Reserve is aggressively raising interest rates. And the rising interest rate environment is sending real estate values into decline. The real estate market has been hit hard, especially commercial real estate. Practically everyone is raising questions about the actual values of real estate. That is especially true of the real estate holdings in private funds such as Blackstone's BREIT. Just as a comparison, the $35 billion Vanguard Real Estate ETF has plummeted 26% year to date. But, what do you think? Please press the like button and leave us a comment below. Please hit the subscribe button and hit the bell icon so that you are notified of upcoming videos. Please share this video on social media. Thank you for watching.